The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Transfer for Value Rule Revisited. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Amber, thank you very much. I'm glad that all of you have joined us today on this day before the 4th of July holiday. Thank you for that. We're going to talk today about the transfer for value rule, and we'll go over it in a little bit of detail in 15 minutes. But before we do that, let me tell you that instead of the webinar that we had scheduled for August, which was Trust as Beneficiary of an Annuity, we've decided to talk about the Supreme Court's decision in the Connolly case. We've been asked about that, Jennifer and I have, quite a bit lately. And so mark your calendars if you're interested in hearing about it for August 7th at our regular time, 11 o'clock Central. As a reminder, these webinars are put on free of charge as a service to life insurance and financial professionals. We're glad for people to join us. And so if you know of a person who might benefit or might be interested in the content that we're going to give next month, feel welcome to invite them to the webinar and send them the link, and we'd be glad for them to join us. All right, well, with that out of the way, let's go ahead and get started. Let's talk about the transfer for value rule. Here's what we're going to talk about today. First of all, we're going to go over what the rule is. Next, we'll talk about the exceptions to the transfer for value rule that are built right into the tax code. The third thing we'll talk about is the popular misconception that we at Advanced Underwriting Consultants get asked about, it feels like, on a regular basis. We'll talk about a couple of examples of how the transfer for value rule can rear its head, and then we'll conclude with some thoughts about the transfer for value rule and the kind of tips that you might have in mind as you think about working with your clients. So let's go ahead and get started with a review of the transfer for value rule itself. And as a reminder, the transfer for value rule finds its place in Revenue Code Section 101. And for those of you who are not code junkies like I am, Code Section 101 is the code section that says the death benefit of a life insurance policy is income tax-free. Remember that the IRS takes the position that just about all income is taxable unless there's a specific exception. Code Section 101A specifically exempts life insurance death proceeds from income tax. That's the source of the idea that life insurance death benefits are income tax-free. Well, what's the bad news associated with that? Well, it's the transfer for value rule. And this is language lifted directly from Code Section 101A, and that is that if it says, if in the case of a transfer for valuable consideration, the amount excluded from gross income shall only be basis. Anything in excess of basis is going to be income taxable. right? So if you transfer a life insurance policy for valuable consideration, you are making most of the death benefit income taxable. And that's a very bad result, right? The difference between tax-free and taxable could mean as much as a difference of 40% of the death benefit that is available for family. When you take into account both federal and state income tax possibilities. And so we want to avoid transfer for value problems if at all possible. So let's talk about the normal, the regular exceptions to the transfer for value rule. Again, we're looking at the tax code. And this is pulled directly from Code Section 101A. And Code Section 101A2 says specifically that it is okay to make a transfer for value under certain conditions. First of all, the first part of 101A2 says that if you make a gift, it's not a transfer for value, and therefore a gift of a life insurance policy, a true gift of a life insurance policy, will not trigger the transfer for value rule. So a gift of a life policy from one person to another does not endanger the tax-free nature of the death benefit. This capital A section also brings into play the possibility of a sale of a life insurance policy between husband and wife. By rule in the tax code, if you sell, if husband sells a policy to wife for a real price, by rule, the basis of the policy in the hands of the wife stays the same as it was in the hands of the husband, regardless of any money that or anything else of value that changed hands. And so generally a transfer from the insured to the spouse is an exception to the transfer for value rule. The other parties to whom a transfer can be made without worrying about triggering the transfer for value rule are listed below. A transfer to the insured is an exception to the transfer for value rule. A transfer to a partner, a real income tax partner of the insured is an exception to the rule. A transfer to a partnership in which the insured is a partner is an exception to the transfer for value rule. And then a transfer to a corporation in which the insured is an officer or a shareholder, that's an exception to the transfer for value rule. So if transfers are made to these exempt parties that are listed, then it is not a transfer for value causing a problem with the death benefit. So that's good news. There are some exempt transferees, and being able to know these exempt transferees is important for those of us who are active in the life insurance business. Now, Jennifer and I get asked about this kind of circumstance all the time, and people say, well, this is an exception to the transfer for value rule, so there's no income tax result. So let's talk about that. The popular misconception arises under these kinds of circumstances. Let's take the case of Susan, who we are saying is the 100% owner of a C corporation, and the company itself owns insurance on Susan's life. And let's say that the company paid $60,000 in premium for that life insurance policy. The company-owned policy is now worth $100,000. And the company intends to transfer the policy from itself to Susan, the insured. And a lot of the calls that Jennifer and I get go like this. The caller says, well, this is a transfer to the insured, so therefore there are no tax consequences of the company making a transfer to Susan because it's an exception to the transfer for value rule. And that's not quite true. While it is true that a transfer to the insured does not create a transfer for value problem, what that means in this context is the death benefit, when it is paid to Susan's beneficiary, will stay income tax free. So that's what the exception means. The death benefit is going to stay income tax free. However, the transfer of the policy from the business to Susan has other income tax consequences. And there are three income tax consequences, or three likely income tax consequences in this case. The first one is that the company is disposing of the life insurance policy. Therefore, it is treated as a taxable surrender of the contract from the C corporation's perspective. The C corporation will recognize taxable gain to the extent of the $40,000 gain that is in the policy. The second tax consequence, assuming that there's an election to treat the transfer of the policy from the business to Susan as a bonus, that the company will get a tax deduction for all $100,000 of policy value that it is transferring to Susan, because compensation, as long as it's reasonable, will be deductible by the business. And then the punchline for Susan is that all $100,000 of value that she receives from the company to her own self is treated as a taxable compensation, taxed like any other compensation. Some of you may be thinking to yourselves, now wait a minute, couldn't this be treated as a dividend? The answer is yes. If it is treated as a dividend, there is no tax deduction by the company when the transfer is made to Susan. And Susan will still recognize taxable dividend for equal to the value of the policy that she receives from the company. So those tax consequences need to be thought about, even though the transfer of the policy to Susan does not create a transfer for value problem. There are tax consequences associated with the transfer. So let's talk about a couple of examples where the transfer for value rule can arise. Let's talk first of all about Tom and Jerry, who are co-shareholders in an S corporation, and they've got an existing entity purchase buy-sell agreement. They decide to switch to cross-purchase because they heard that it's better. And so instead of buying new life insurance coverage, they transfer the existing policies that had been used to fund the entity purchase, business-owned life insurance policies. They decided to transfer those so that they match up with a cross-purchase buy-sell configuration. So the policy that the company owns on Tom's life goes to Jerry, and the company-owned policy on Jerry's life gets transferred to Tom. So that's a classic transfer for value issue. Unless Tom and Jerry are partners in a real business partnership, the transfer to the co-shareholder, not to the insured, is a transfer for value. And that will make most of the death proceeds income taxable when they are paid, and that's a problem. And so if you run into that circumstance, you need to recommend that Tom and Jerry consider another way to manage the transfer for value problem. One way might be to write new coverage. Another way might be for them to put together a partnership. Another way might be to convince their attorney to keep the entity purchase buy-sell arrangement instead of the cross-purchase arrangement. All of those ways are reasonable alternatives to manage the potential transfer for value problem. Let's talk about another situation where on the personal side, transfer for value might come up. Talk about Stan and Oliver. Let's say that Stan goes to Oliver and says, hey, Oliver, transfer ownership of your car to me and I'll make you the beneficiary of my life insurance policy. That's transfer for value. Stan is making an enforceable promise to Oliver that he's going to make Oliver the beneficiary on Stan's life insurance policy in exchange for the car. No doubt about it in my mind, that's transfer for value. That's not a gift, and that's transfer for value problem. In another way for them to create a transfer for value problem is to agree to name each other the beneficiaries on their life insurance policies that are personally owned. they make a promise to cross beneficiary each other in exchange for the return promise, that's a transfer for value as well. Even though no physical transfer of the insurance policy was ever made, they are making the death benefit of the life insurance policy income taxable. Well, you might ask, how's the IRS ever going to find out about that? That's a different question, right? The IRS might find out about it, and if the IRS does, there's no doubt in my mind that the IRS will treat that as a transfer for value and will impose income tax on the death proceeds at the death of the insured. All right, so let's figure out what to take away from today's session. First of all, transfer for value problems can arise unexpectedly. The consequences are severe, so we really need to pay close attention. A transaction without a transfer for value problem can still have tax consequences. We talked about that in the context of a transfer from a business to the insured. While there is no transfer for value problem there are income tax consequences in making that kind of transfer, and we need to explain that properly to our clients. And then the last takeaway from my perspective is there are lots of potential solutions to transfer for value problems. They need to be thought through. And if you're unsure about how to solve those problems, how to address those problems in a situation where transfer for value is arising, talk to your preferred advanced sales consultants. You know, if you've got a relationship with advanced underwriting, talk to Jennifer or myself. Or if you've got other relationships, talk to your advanced sales team for helpful ideas that might be available in the circumstances that you have right in front of you. I'd like to thank all of you for joining us today. I wish you all a happy 4th of July holiday tomorrow, and I'll turn the program back over to Amber to wrap us up. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, August 7th, at this same time. Next month's webinar will be titled The Supreme Court's Decision in Connolly. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.